Welcome to Value Investing, the Starvine Way, where my goal is to help you learn more about value investing and compounding wealth with a long-term focus. I'm your host, Stephen Coe, founder and portfolio manager of Starvine Capital. Welcome back to the podcast. In this episode, we continue our deep dive into Pulak Prasad's investment philosophy as laid out in his excellent book, What I Learned About Investing from Darwin. If you've been following along, you'll remember that the book is divided into 3 sections. In the last episode, we focused on the first one, avoiding big risks, which is all about defense, how to stay alive in markets that are unpredictable by nature. Today, we move to the second section, buy high quality at a fair price. This is where the focus shifts from survival to intelligent offense. How to identify great businesses, identify what makes them durable, and buy them at prices that make sense. Let's quickly recap where we left off in the last episode. The gist of the first section of Pulak Prasad's book is this. If you're clear about what risks make an investment a non-starter, you can dramatically narrow down your universe of potential ideas, and in doing so, eliminate a ton of noise. Prasad listed several categories of businesses he simply avoids altogether. Crooks, turnarounds, companies with high debt, serial acquirers, fast-changing industries, and firms with unaligned owners. He makes a great point here. The financial media loves to talk about what to buy, but the reality is learning what not to buy is just as important, and arguably even more so. That process alone eliminates a huge chunk of companies, and that sets the stage for part 2 of the book. Figuring out how to identify high-quality businesses and then buying them only when the price is right. But here's the thing, even after cutting out the obvious bad apples, you could still be left with hundreds of companies to review. So where do you start? Public markets are overflowing with data. Annual reports, conference calls, investor decks, ratios. You can drown in information if you're not careful. That's why Prasad developed a 2-step filtering process at Nalanda to narrow this field further. Step 1, use a single selection criterion, just one metric to filter out low and average quality businesses. This produces a preliminary list of high quality candidates. Step 2, do deeper qualitative work on that short list to narrow it down even more. Now, what is the single magical criterion? Prasad calls it the F filter. He starts with an investable universe of about 800 Indian companies with market caps above $150 million. And after applying his qualitative rules from section 1, remember avoiding big risks, that number drops to roughly 450. Then with the F filter, it falls again down to about 150. And after more deep dive analysis, the team ends up with a final focus list of 75 to 80 names. So from 800 to 80, they've effectively eliminated 9 out of 10 companies. And this is where I couldn't help but think of the Moneyball analogy. In baseball, Billy Beane revolutionized the game by focusing on on-base percentage, or OBP, the stat that measures how often a player gets on base, regardless of how flashy the hit was. Prasad's F filter works in the same spirit. Instead of measuring how well a player performs in the field, it measures how efficiently a company generates profits from the capital it employs. That metric is called return on capital employed, or ROCE. Now, I'm not going to turn this into a finance lecture, but if you're curious, here's how it's calculated. ROCE equals operating profit. That's earnings before interest and taxes, divided by capital employed, which is the sum of net fixed assets and non-cash working capital. You can pull all those numbers straight from a company's financial statements, no wizardry required. But the real takeaway isn't the math, it's the mindset. By focusing on how efficiently a business converts capital into profit, rather than on short-term growth stories, Prasad and his team have built a disciplined, repeatable way to filter out for enduring quality. Alright, let's dig into what might be the most important idea in Pulak Prasad's entire framework, return on capital employed, or ROCE. So why does Prasad fixate so intensely on this one metric? Why is it the number that separates great businesses from the rest? He compares it with other commonly used measures like operating margin or return on equity, Those can be useful, but they're incomplete. He gives a great example, Costco versus Tiffany. Now, Tiffany's operating margin pre-pandemic was a hefty 19%, while Costco's was just 3%. You might assume Tiffany's the better business, but you'd be wrong. Costco actually delivered a higher ROCE, about 22% compared to Tiffany's 16%, because it turns over its inventory incredibly fast. Tiffany, on the other hand, has to sit on large amounts of slow-moving inventory. So even though Tiffany looks more profitable on paper, Costco's capital efficiency makes it the superior business. And that, in a nutshell, is why ROCE trumps most other measures. It tells you how effectively a company converts every dollar of capital, not just sales, into profit. Now, what about return on equity, or ROE? Prasad points out a major flaw there too. ROE mixes operating performance with financing structure and tax strategy. In other words, a company can take on debt, use clever tax planning to make ROE look better, but that says nothing about the true quality of the business. ROCE strips all that out. It's pure operating performance. As Prasad puts it, a business earning 20% ROCE is like a bank deposit earning $20 for every $100 you put in year after year. You'd be over the moon to own a company like that. They're rare, but they exist. And here's where it gets even more interesting. By setting a high bar on ROCE, you actually get a bunch of other desirable traits for free. Think of it like this. A teacher looks at the top 5 students in a class of 30. Odds are those 5 will also have things like good attendance, discipline, and work ethic. The same logic applies to businesses with consistently high ROCE. They tend to come with a package of positive traits. So what are those traits? First, great management. Maintaining a high ROCE in any industry over many years is brutally hard because competition is always trying to erode your advantage. Nolanda's portfolio of 30 businesses has a median historical ROCE of 42%. That's pretty extraordinary. Second, sound business practices. Prasad points out that high ROCE companies typically deliver excellent products, manage costs well, keep their balance sheets clean, and take calculated risks. They know how to reinvest intelligently and attract top talent. Third, competitive advantage. When Nolanda shortlists a company based on high ROCE, they don't stop there. They dig deeper to make sure those returns are sustainable. Sometimes they find that the company was just lucky, that its high returns were a fluke, but often they uncover durable advantages like strong intellectual property, network effects, and economies of scale. Interestingly, Prasad calls brand power the weakest of these advantages. He points to the US market where 80 to 90% of new brands fail. Fourth, good capital allocation. ROCE is a fantastic proxy for how efficiently management deploys capital. As Prasad says, great businesses don't try to maximize operating profit or minimize capital employed. They try to earn the most profit per unit of capital deployed. That line is critical. It's the investing version of Moneyball. Billy Beane didn't care about flashy players. He cared about how efficiently they got on base. Likewise, Prasad's focus on ROCE is about how efficiently a company converts investment into results. He also points out that a company with a consistently high ROCE almost certainly makes good decisions across the board, whether that's choosing between in-house R&D or buying talent externally, running a Super Bowl ad versus smaller digital campaigns, or deciding when to repurchase shares. High ROCE implies that management, on average, allocates capital well. And then there's the final benefit of high ROCE, and that's easy to overlook, but maybe the most powerful of all. A high ROCE company can take business risk without taking financial risk. Let's unpack that. Every company that wants to grow has to take risks. Play it too safe and you stagnate. Go too far and you blow up. The sweet spot, Goldilocks zone as Prasad calls it, is taking calculated risks. Now here's why ROCE matters so much mathematically. Imagine two companies, X and Y. Same growth rate, same margins, same taxes. The only difference, Company X earns 25% return on capital, Company Y earns 12%. After 5 years, Company X is sitting on a pile of cash, nearly 18% of sales. Company Y, meanwhile, is in debt equal to 3% of sales. Same business growth, totally different financial outcomes. That's because the high ROCE business generates more cash than it needs to fund its growth, while the low ROCE business constantly needs to borrow or issue shares to keep growing. You can probably see where this goes. Over time, the strong get stronger. The high ROCE company ends up flush with cash and flexibility, while the low ROCE company stays perpetually fragile. This dynamic becomes self-reinforcing, a flywheel of strength. A perfect real-world example is Havells, one of Nalanda Capital's biggest winners. Havells is India's largest electrical equipment maker. They sell fans, lighting fixtures, appliances, the works. From 2007 to 2017, Havells earned an average ROCE of 52%. That's enormous. By 2017, they had grown revenue at 15% a year for a decade and were sitting on $230 million in cash. Then they made a bad acquisition, a company called Lloyd Electric. Total strategic mismatch. Havells focused on premium products, while Lloyd sold low-end air conditioners. But here's the thing, Havells could afford to make that mistake. Because of its high ROCE, it had cash to spare. It wasn't leveraged, so it could invest another $35 million to reposition Lloyd's products and modernize operations. And it worked. If Havells had been highly indebted, that mistake might have been fatal. But because it was a high ROCE company, it could absorb the hit and come out stronger. Now, Prasad isn't saying ROCE is perfect. It's a starting point, not the finish line. It's backward looking. It reflects the past, not the future. And yes, conditions can change. Management can make a bad acquisition or a moat can erode. And sure, this approach might cause you to miss some spectacular outliers like Netflix and Amazon, which would have failed a high ROCE screen in their early days. But Prasad's conclusion is pragmatic. You don't have to catch every 100 bagger to do well. You just need to consistently play the odds in your favor. And if you stick with high ROCE businesses bought at fair prices, the odds, mathematically, operationally, and psychologically, are stacked in your favor. Alright, moving on to chapter 3, robustness. This is where Prasad takes us into the next layer of his investment framework. What it really means for business to be robust. So far, we've covered two big building blocks. First, avoiding big risks. This was the focus of the last episode. Second, using return on capital employed, or ROCE, as a first filter to identify high-quality companies. Now we're going a step deeper, taking that short list of promising companies and asking which of these are actually built to last. Prasad defines robustness as the ability to function well despite internal and external disturbances. Or to put it in plain English, the ability to take punishment without collapsing. And because this is Pulak Prasad, of course he turns to nature for his analogy. He points out that living organisms are incredibly resistant to change, and that this resilience exists on multiple levels. Let me give you a super high level version of what he explains. Our DNA, amino acids, and proteins can all undergo mutations or rearrangements, and yet, in most cases, the organism still functions perfectly fine. The DNA code can mutate and still produce the right amino acids. Amino acids can swap around and still build the right proteins, and even proteins can reorganize while the body continues to operate normally. So the big takeaway from biology is this. Robust systems can withstand errors, shocks, or mutations across many levels and still survive. Now, what does that mean for business? Well, unlike ROCE, which is a nice, clean, quantitative number, robustness is much more qualitative. You can't calculate it on a spreadsheet. You have to observe it. Prasad offers 7 traits that typically indicate robustness in a company. 1, a high return on capital sustained over many years. 2, a fragmented customer base, meaning no single customer can sink the company. 3, no debt and ideally excess cash. 4, barriers to entry that protect against competitors. 5, a fragmented supplier base, so the company isn't overly dependent on any one source. 6, a stable management team. Consistency in leadership and culture. And finally, a slow-changing industry where the rules of the game don't get rewritten every few years. In other words, robust businesses are like organisms with multiple layers of defense. They're not fragile. They're built to take hits, adapt, and keep functioning, whether the disturbance is internal missteps or external shocks. And that's what Prasad wants, companies that can take a punch and still move forward. Prasad argues that while adaptability is essential, we can't actually predict in advance which companies will adapt successfully. So instead of trying to forecast adaptability directly, it's more reliable to look for robustness That is, strength and stability that allow a company to endure shocks and keep growing. And it is on that logic that Prasad sees robustness as a kind of prerequisite for evolution. Now, one of the best real-world examples comes from Page Industries. You might not have heard of this company, but it is India's largest seller of innerwear and one of Nalanda's biggest success stories. Nalanda bought into Page just days after the Lehman collapse in late 2008 at the height of global panic. If they've held it ever since, it's become more than a 100 bagger, not even including dividends. Here's what made Page Industries so robust. By March 2020, right before COVID hit, it had a 63% return on capital employed, zero debt, a highly fragmented customer and supplier base, and a stable ownership structure in a slow changing industry. In other words, all the characteristics of a company built to withstand stress. And that resilience paid off. During the pandemic, while many competitors stumbled, Page actually increased its market share from 66% to 70%. Prasad's takeaway is that businesses need multiple layers of robustness, not just one, and the reason is simple. Nalanda invests with a permanent time horizon. They buy truly as if they'd never sell. And as Prasad puts it, if a business can't last permanently, we don't want to own it. That's why the bar for durability has to be set so high for him. Now, here's where it gets interesting. Robust businesses don't just survive. They evolve by taking calculated risks. Prasad describes a Goldilocks zone. Not too hot, not too cold, where companies take just enough risk to innovate and grow, but not so much that they endanger the franchise. As he puts it, it's the degree of risk that makes managers uncomfortable, but not too much. And this philosophy shows up again, almost word for word from Bruce Flatt, the CEO of Brookfield Corporation, during his 2025 Investor Day. Brookfield, by the way, has outperformed even Berkshire Hathaway over the past 30 years, compounding shareholder returns at roughly 19% annually. Flatt said, and I'll paraphrase it here, "We try to encourage small evolutionary changes because if you don't change, you go backward. That means accepting some mistakes along the way, but never betting the farm, keep the downside protected, push the edges, and stay at the forefront, especially now with the AI revolution reshaping every business in the world." It's almost eerie just how closely Flatt's thinking echoes Prasad's. Both view evolution as essential, but reckless risk as fatal. Incremental improvement, discipline, and endurance. That's how both nature and great businesses survive and thrive. Now, here's an important nuance in Pulak Prasad's thinking. Robustness is a proxy for success, but not a guarantee of it. He makes this point beautifully with an example from nature. Think about dinosaurs. They were among the most dominant and diverse creatures to ever walk the planet, 180 million years at the top of the food chain. Compare that to us, Homo sapiens, who have only been around for less than 200,000 years? Yet despite their incredible robustness, one asteroid 65 million years ago wiped them out completely. And the same thing can happen in business. Even companies with multiple layers of robustness, strong balance sheets, high returns on capital, great management, and durable moats can still falter. Prasad shares a few rare examples from his own portfolio where, despite checking every box, things went sideways. In one case, the company's receivables and inventories ballooned, forcing it to borrow money and eventually sell assets. He exited that one at a loss. In another, the business was too robust, almost paralyzed by its own caution, so focused on stability that it stopped evolving altogether. The lesson: robustness improves your odds, but it's not foolproof. Still, by requiring multiple levels of it, you dramatically increase your chances of owning companies that take calculated incremental risks and, crucially, those that use crises as a springboard for growth. So, how do you protect against the loss of robustness? Prasad's answer is quite straightforward. The only safeguard is the price you pay. He views valuation as one factor investors can actually control. Everything else, margins, moats, customer relationships, those can change over time. But the entry price, that's entirely in your hands. And this, he told me personally in our video call last year, is the key to beating the index. And that is that you must own businesses that are both higher quality and cheaper than the index. Now, that's easier said than done because companies that possess all the traits Prasad looks for almost always trade at a premium. That's where patience comes in. When I spoke with him, he mentioned that he hadn't added a single new idea to the Nalanda portfolio in 2.5 years. Now imagine that, 2.5 years of waiting, but eventually the window opens. The market misprices quality, and that's when he acts. And just to put numbers around Nalanda's discipline, the median entry PE ratio for their investments is 14.9 times earnings compared to 19.7 for India's Sensex and 23.8 times for the mid-cap index. So they're buying exceptional businesses, but at a 25 to 30% discount to the market average. In the end, it comes down to this simple truth. What locks in your long-term outcome isn't where the stock trades 99% of the time. It's the price you pay on the day you buy it. The next chapter in Pulak Prasad's book is called The Perils of a Pavlovian. Now, to understand what this means, let's start by going backward. A Pavlovian response is basically a conditioned reaction, something your brain and body learn to do automatically after repeatedly pairing two things together. Think of feeling hungry every time you drive by a McDonald's location, or reaching for your phone the second you hear the notification sound, even when it's not yours. In the investing world, the same kind of a conditioning happens. When markets fall, investors reflexively sell. Things go up, they chase. Prasad argues that this reflex, this Pavlovian behavior, is exactly what separates average investors from those who create outsized wealth. He made his investors a lot of money precisely by not reacting that way, by doing the opposite during moments of panic. Two key examples, the 2008 financial crisis and the COVID crash of 2020. Both times, he bought aggressively while the world was melting down. Why? Because markets were panicking about what he called proximate worries, things that seem important in the moment but are irrelevant to a company's long-term intrinsic value. At the start of the chapter, Prasad quotes Warren Buffett from Berkshire's 1994 letter. It is folly to forego buying shares in an outstanding business whose long-term future is predictable because of short-term worries about an economy or a stock market that we know to be unpredictable. Or in plain English, why scrap an informed decision because of an uninformed guess? And that's the essence of this chapter. Most investors, even professionals, let the wrong worries dictate their actions. They focus on the noise, not the signal. Prasad explains that these proximate causes fall into four categories: macroeconomic, market-related, thematic, and company-specific. Let's go through each. Macroeconomic causes are things like inflation data, employment numbers, GDP growth, the stuff economists love to talk about. But Prasad points out that even when the headlines scream crisis, quality businesses tend to recover quickly. He gives the example of the Asian financial crisis in 1997, when global markets dropped 6 to 7% in only 2 days. But 6 months later, the Dow and the FTSE were up 25%, and blue chip names like Walmart, Diageo, and Unilever were up more than 40%. Investors who panicked and raised cash at the bottom missed an incredible rebound. Another macro obsession is interest rates. Fund managers love to guess where rates are headed, and they trade bank stocks as if their entire future depends on it. Yet Prasad looked at 3 Indian banks between 1999 and 2019, HDFC Bank, ICICI, and State Bank of India. Over those 20 years, the Indian Central Bank changed interest rates more than 50 times, swinging between 5% and 12%. And still, HDFC Bank's stock rose 81-fold. Why? Because of one man, Aditya Puri, the CEO. His leadership, not the interest rate cycle, was the ultimate cause of success. As Prasad writes, interest rates, current account deficits, and exchange rates and other such esoteric measures did not get in the way of Puri achieving excellence. And as a side note, anyone who knows me knows I tune out the second someone brings up macroeconomics. Why? Because I've never made an investment decision based on it. To me, it's just pure noise. Real, enduring value is created at the micro level, inside companies, not by predicting the economy. The second category is market-related causes. In other words, trying to predict where the overall market is heading. There are countless highly paid professionals on Wall Street whose entire careers revolve around making these decisions. In my old buy-side days, I sat through many of those presentations. I learned absolutely nothing that helped me become a better investor. If your goal is long-term compounding, macro and market forecasts are irrelevant. They only matter if your goal is to beat the benchmark this quarter. Then we have thematic causes. This is when investors collectively lose their minds over a hot trend, bidding up stocks simply because they fit a narrative. Think of the EV bubble that's electric vehicles, around 2020 to 2021, companies like Nikola, QuantumScape, Velodyne, LiDAR, and Fisker, many with zero revenue, reached sky-high valuations, some above 10 billion. I remember a client texting me back then and asking me about Fisker because a friend said it was the next Tesla. But we all know how that ended. Most of those stocks are down 90% and more. And today, the same thing is happening with AI. Stocks like Palantir trade at over 100 times revenue in 2025. The lesson never changes. Thematic euphoria is usually the best time to sell, and thematic despair is often the best time to buy. The last category is company-specific causes, short-term events that spook investors but have little impact on the long-term business. An example that comes to mind here is JD.com. In 2018, its founder was arrested on assault allegations in the US and later released without charge. The stock dropped 14% in days, then continued sliding after a slightly weaker earnings report. Between September and December, it lost about a third of its market cap. But fundamentally, the business was still growing, revenue up 25%, customer accounts up 22%. The panic created a great buying opportunity. And this is why Prasad's framework matters. Every once in a while, the market panics about the macro, a theme, or a scandal, and prices detach completely from intrinsic value. These are the moments when long-term investors earn their edge. Prasad writes about March 2020 at the peak of COVID fear when Indian markets fell 23%. Nalanda couldn't stop buying. In that single month, they invested more than in the previous 4 years combined. Meanwhile, foreign investors withdrew nearly $9 billion from India. By the end of 2020, Nalanda had invested 1/3 of its entire 13-year cumulative capital in just that 1 year. He wrote, "I don't know if we made the right decision, but I do know that the proximate worries, the fear of doom in businesses like tires, enzymes, and diagnostic services were divorced from their ultimate causes of success." And that's the key takeaway. The world reacts to noise, great investors wait for it, and act when it gets loudest. The next chapter in Pulak Prasad's book is called Darwin Ate My DCF. A funny title, but it carries a serious message. This one's about taking a page from evolutionary biology, a field that studies change by looking only at the past. In biology, you don't forecast, you analyze what actually happened and how species adapted, and Prasad argues that investing should follow the same logic. Now, this is pretty unconventional because almost all investors, including myself, make decisions based on future expectations. We think in terms of next year's earnings, next year's margins, or 5-year cash flow projections. But Prasad says don't do that. Forecasting is full of traps and blind spots that can quietly lead you off course. He illustrates this with a conversation he once had with another fund manager. They were comparing valuations on a company Prasad owned. Prasad remarked that it looked expensive, trading at 45 times earnings. His peer interrupted and said, "No, it's only at 25 times earnings." Now, how can two professionals both looking at the same company arrive at such different conclusions about something as basic as a PE ratio? Again, PE stands for price divided by annual earnings. Well, it comes down to which earnings number you're using. The numerator in the PE ratio, the price, is always the same, but the denominator, the earnings per share, can be historical. That is the company's officially reported results or forecasted what analysts expect for this year or next. So Prasad was using trailing earnings and his peer was using forward earnings, in other words, a guess. That one distinction changes everything. And this is why Prasad basically bans the use of DCF, the discounted cash flow model, from his process. Because a DCF is entirely built on forecasts, projecting cash flows years into the future and then assigning a terminal value, essentially guessing what the company might be worth at the end of that forecast period. But here's the problem. Every input along the way, revenue, growth, margins, expenses, capital spending, working capital, is an estimate. Each one carries a margin of error. Those errors compound within a year and then again over multiple years. So by the time you reach your terminal value, you're stacking guesses on top of guesses and the illusion of precision becomes dangerous. Let's take just 1 year's free cash flow as an example. You start with revenue, number of units sold times price per unit. Already that's an assumption. Then you guess the gross margin, which can swing quarter to quarter if the mix of products changes. Next, you subtract overhead, salaries, rent, insurance, marketing, all variable over time. Then you factor in capital expenditures, both maintenance and growth, plus interest, taxes, and changes in working capital. Each step compounds uncertainty. So the perils of DCF are twofold. First, the math feels rigorous, which gives investors a false sense of confidence. And second, the value is based on a tower of assumptions, compounded on assumptions that rarely reflect reality. Prasad's view is that investors underestimate the power of studying the past and overestimate their ability to predict the future. So what's his alternative? He focuses on what can be known, a company's demonstrated economics, stability, and quality, and then insists on paying a price that bakes in a margin of safety. Here's how he puts it. Take a non-cyclical business growing at a moderate pace. We know the market's average trailing PE is about 19 or 20. We pay a multiple at or below the market for an exceptional business with high returns on capital, a wide moat, and low risk. Occasionally, we stretch into the teens or low 20s for a truly unique business, but those cases are rare. The median trailing PE ratio for our portfolio at purchase is 14.9. So he's not forecasting growth. He's valuing based on what the business has already proven it can do. And that's the Darwinian twist. Prasad studies survival traits, not future mutations. Next up, convergence. This chapter 6, is one of my favorites because it gives you something that strengthens both your defense and your offense as an investor. It's about identifying repeatable success and avoiding unnecessary risk by recognizing patterns that nature figured out long before finance did. At the top of the chapter, Prasad opens with a quote from Charles Darwin. It goes like this. I am inclined to believe that in nearly the same way as two men have sometimes independently hit on the very same invention, so natural selection, working for the good of each being and taking advantage of analogous variations, has sometimes modified in very nearly the same manner two parts in two organic beings, which owe but little of their structure in common to inheritance from the same ancestor. Alright, that's a mouthful, so let's unpack it. Darwin's basically saying that two completely unrelated species can evolve to look and function similarly if they're adapting to the same environment. Just as two people might invent the same thing independently, nature tends to find similar solutions to similar problems. Now apply that to investing. If similar conditions require similar traits for survival, then in business, similar conditions require similar business models to thrive. That's what Prasad calls convergence. He says Nalanda doesn't actually invest in companies, it invests in templates for success. In other words, there are certain types of businesses and business models that reliably produce strong results across geography and time. Likewise, there are business models that almost always struggle, like airlines. And this concept changes how you think about research, because doing a deep dive on a company takes a lot of work. So why spend that energy on something that, right from the start, belongs to a category that rarely succeeds? Instead, focus your time on companies that fit the pattern of winners. One of the examples Prasad gives is IT outsourcing. He points to companies like Accenture, Cognizant, Infosys, and TCS, all earning 40 to 50% returns on capital for decades. It's a convergent industry, one that consistently produces winners. So when Prasad looked at Mindtree, a smaller Indian IT services firm, he could reason that if the same conditions applied, a scalable model, sticky clients, and global demand, there was a high probability that Mindtree could follow a similar path. Now that's convergence at work, but, and this is the key, he warns that the work doesn't stop there. You still need to check all the boxes. Valuation, financial strength, management quality, capital allocation, customer concentration, and market position. Convergence gives you a starting edge, but not a free pass. Then he applies the same logic, this idea of converging evidence, to valuation itself. Prasad points out that decades of empirical research show a strong, consistent pattern. Low valuations lead to higher long-term returns. It's been true across countries, industries, and eras, so why defy the odds? Even though Nalanda prides itself on deep qualitative work, Prasad admits that he trusts convergence more than his own intellect. In his words, it's about playing the odds. And this brings us back to one of Buffett's favorite anti-patterns, airline industry, a textbook case of non-convergence. As Buffett once quipped, if a capitalist had been present at Kitty Hawk, he should have shot Orville Wright. Airlines as an industry have destroyed more capital than they've ever created. So Prasad asks, why spend time and resources diving deep into a business that, from the start, has a low probability of delivering sustainable high returns on capital? Again, he doesn't invest in businesses, he invests in templates that work, in business models that have proven again and again to create value across time and geography. And he's perfectly fine missing out on the occasional Amazon of the world, because yes, a few outliers do change the game, but Prasad's goal and really Nalanda's philosophy is to build wealth by stacking the odds in their favor, not by betting on exceptions. Here are the big takeaways from this episode. 1. Filter for quality with ROCE. Return on capital employed isn't a cute ratio. It's the Moneyball stat for businesses. High, sustained ROCE is the cleanest read on a company's engine. Great operations, smart capital allocation, real moats, and the ability to take business risk without taking financial risk. Over time, high ROCE firms build cash and optionality. Low ROCE firms always face an uphill battle. 2. Robustness beats prediction. We can't reliably forecast adaptability, so we look for systems that don't break. Diversified customers and suppliers, excess cash, high entry barriers, stable leadership, slow changing industries, and a long history of high ROCE. Robust companies survive chaos and are in a position during such times to gain share. 3. Respect convergence. Certain business models win across time and geography. Think IT services. And certain models chronically destroy capital. Again, airlines. Stack the odds, favor proven templates, and keep valuation discipline. We're not hunting miracles, we're hunting patterns. And 4th, price is the only thing you can control. Everything else can change. Your entry price doesn't. Buying higher quality businesses below the market's multiple is the quiet superpower. You won't catch every 100 bagger. Don't need to if you keep the math, the moat, and the margin of safety on your side. If you stitch those together, Section 2 was really about intelligent offense. In the third and final installment of What I Learned About Investing from Darwin, we're going to talk about doing less on purpose. That is, inactivity as a strategy, not a flaw, and the power of patient timing. We hope you enjoyed this episode. If you did, please like, subscribe, and share. Questions can be sent to podcast@starvinecapital.com. On a final note, thank you for the online reviews as that helps us get discovered.